Have you ever wondered if the economy will affect your retirement plan? By the end of this video, you will gain clarity for your personal retirement plan and have action items to secure your retirement.
To learn more about securing your retirement and all the different elements you need to know, subscribe to our channel and hit the bell to be notified when we post a video every Monday. We have helped hundreds of our clients gain clarity and get on the path to a comfortable and happy retirement. Now it's your turn. Let's dive in.
Kind of start us off here today and give us your thoughts of 2021, where we are so far. We've made it through right now the first quarter, just barely, but we've made it through the first quarter. Can you kind of give us your ideas or thoughts where we've come from through 2021, and we'll just take it from there so far through the first quarter?
Yeah, fantastic. Well, let's break it down into two pieces. Let's talk the economic side, and then let's talk the market side. And the economic side, the biggest contributing factor to what we've seen so far this year has been the vaccinations. And we started, if we look at the data and we look at COVID, which had such an enormous impact last year, and that was a major question here as we went into the first quarter. There was questions whether this first quarter would see any growth. There was chances we could be somewhere close to zero, possibly a little negative. Well, we found out at the beginning of the year, first, second week of January, that the vaccines were having an impact, and they were showing up in the data. Now some of that, too, is that we're off of the travel from Thanksgiving, from Christmas. We were getting past the travel from New Year's, but we start to see about the second week of January a significant decline in terms of COVID cases. And we saw about an 80% decline in new cases. We saw about a 76% decline in hospitalizations. And with that, we saw states starting the reopening process, which, quite frankly, from an economic perspective, reopening is the best possible stimulus we could ask for. Now, I will say February had its ups and downs. We had the winter weather that came through ravaged places like Texas, so we saw volatility in the data. But right now, we're getting data for the month of March, and we just got the employment report. It showed right around 1 million jobs added in the month of March. We're seeing acceleration in employment. We're getting data from the manufacturing sector. We're seeing it from the service sector. And what the data is consistently showing is that as the vaccines get out, as we reopen up, as we get past that February winter weather, we are seeing a very strong pace of activity going into the second quarter. Now, it's not without its difficulties there. One of the problems that we've been running into is supply chain disruption. We cannot get goods and services out to companies, out to consumers fast enough. I think that's going to be a major talking point here in the second quarter. But from an economic standpoint, the fundamentals today are quite strong. It looks like first, second quarter of this year are going to be two of the best quarters that we've seen in a very long time. Now, switching gears for a moment to the markets-based side, the markets, too, have been moving higher. And I think you can kind of see reflected in some of the market movements what we're seeing on the economic side. As we look at reopening, as we look at getting back in person, getting back towards quote-unquote normal, those areas that lagged last year, that lagged because they had difficulties, they couldn't do the face-to-face business, they're starting to take a lead this year. We're transitioning a bit from technology, from communication services, from healthcare, and we've seen financials, we've seen energy, we've seen industrials and materials. And I think that, too, as we get back to normal, that's going to be a major discussion on the market side and the economic side, at least through the first half of this year. Now, the last thing I want to note is that we also got stimulus. I believe that the reopening was the best stimulus we could ask for, but there's money in the system. And in the month of March, the IRS put over $240 billion into bank accounts through stimulus payments. That money, we're going to see that flowing through. We saw it a little bit at the end of March. In April, May, into June, I think we're going to see accelerated spending. So it's kind of a double tailwind. We're getting back to normal, plus there's going to be more money in pockets. Both of those set up for what I think is going to be an incredibly strong second quarter.
Yeah, Andrew, thanks for that summary. And, 2020 was a very scary year. And the story was, like you just said, large cap and technology. And then we saw that shift happening. We were fortunate enough to make a shift in our portfolios at the beginning of the year into those small cap, mid cap positions that really had a lot of recovery to do. And because of the vaccine, because of the stimulus and everything, people going back to work, that has really been a great play for us as far as our portfolio is concerned. Our clients are happy. We're very happy. And so on the note of the stimulus, we've talked about this in previous podcasts as well. And what we think the overall, we could say the overall down the road, how this is all going to play out of all this creating of money. And now recently, in the past couple of months, we've had a lot of worries about inflation, and the Fed's had to come out and address that issue. So what are your thoughts on all this money being put into the markets for good reason? The world needs money right now. The people need money. So what are your thoughts on how all this is going to play out, and tie it to the inflation worries that everyone has had recently?
Yeah, absolutely. So there's kind of short-term effects and there's long-term effects. In the short term, it means a boost in spending. When you give money to consumers, when you give it to businesses or give it to states and municipalities, hospitals, schools, they'll spend the money. That is certainly one of the factors that's lifting economic growth, and I think it's going to also lift earnings here in 2021. And remember, when we look at something like the stimulus plan that was passed earlier this year, $1.9 trillion, $1 trillion of that is allocated to this year. The other $900 billion is 2022 and beyond. So it's not just a this year thing. It's an allocation that's going to extend into future years as well. Now, that money, a lot of it is sitting on the sidelines. Consumers got stung back in 2008, 2009, right? And it took people a while to get the confidence back that the recovery was indeed real, that, for people to have faith once again in the markets. We saw money move to money market accounts, checking accounts, savings accounts. Now they've got stung again, and we're seeing something similar. You've got this environment where they've received funds, their incomes are up over the past year, but again, they're putting it into accounts on the sidelines. It's not all flowing back into the market, and they're not spending it all in terms of buying goods and services. As confidence returns, I expect we're going to see some of that money move back into the system, and one of the big concerns is inflation. We talked about earlier the fact that supply chains are still recovering. We don't have full worker capacity at manufacturing facilities. If you were to go look off the coast of LA today, you would see dozens of ships waiting to dock and unload because there's not enough dock workers, there's not enough truck drivers to move them throughout to the country. So we're going to see it in the next few months, because remember, as we move into the second quarter, particularly April, May, the comparisons from a year ago are comparisons during the shelter-in-place and the lockdown periods. So inflation numbers are going to rise. They took a massive decline last year. So just regular growth is all of a sudden going to see a spike. We're going to see inflation numbers, consumer prices, producer prices, somewhere in the 3 to 4% range here over the next few months. Over the last decade, it's been below 2%. It's been 1.5%. So we're not really talking numbers like we saw in the 70s or into the early 80s where it was double-digit inflation, but I do think it's going to run above trend. It's supply of money, it's the confidence returning, and then it's going to take us a little while to get that demand back online. And when you put that much new money into the system, inflation is one of the side effects.
So, again, what I'm about to talk about is kind of a little bit speculative at this point because it's got some work to do. But, they're talking now about this infrastructure bill that's going to now put another couple $1 trillion into, building some infrastructure within the United States. And they're saying, hey, we're way behind in that as well. What do you think about that? I mean, if that actually were to go through, how do you see that affecting things?
Yeah, so if it goes through as it's put in right now, I think it would have an inflationary impact. It's going to be more money coming into the system. Again, it would be a short-term boost to growth. The money that's allocated in the stimulus plan is over a wide variety of pieces. If you were to break it down and look at, say, how much of that is towards roads and bridges, I think it's about 5% of the total money that's allocated. It goes across a large number of topics. This stimulus is a little bit trickier to pass through than what we saw with the $1.9 trillion plan for a couple reasons. One is there was an impetus on that prior plan that we saw pass through in the month of March because we were about to see the expiration of extended unemployment benefits. If it didn't get passed through in time, we were going to see those fall off. So there was kind of a deadline. There was a shot clock running, and they said, look, we need to get this passed through we need to figure out what we're doing by this point in time. We don't have that with the infrastructure. There's not a shot clock running. There's more time for debate. There's more time for discussion on the infrastructure bill. And because of that, I think it's going to take a little longer to pass. The other thing is that we've seen some of the, let's say, moderate Democrat side, like Joe Manchin, like Tester, like Sinema out of Arizona, and Kelly, kind of leaning and suggesting we want this to be a bipartisan bill. We do not want this to be a 50-50 split along party lines. And so with that, I think there's going to be more negotiation needed in this plan than there was in the stimulus plan, because they need those Democratic votes. And if those Democratic votes say, we're not going to do it unless you have agreement on the other side, there's compromise that's going to need to be made. And the last thing I would note on here is that there's been a lot of discussion, what is this going to look like? Is this going to be green energy, and how far is it going to go in green energy? Well, we kind of got to look at this during the $1.9 trillion stimulus plan discussions. There's this thing called Vote-A-Rama, and basically the Republicans could throw up a bunch of different topics for votes as they were looking to pass that prior stimulus, and they brought up questions like green energy. They said, would you vote to ban fracking, something along those lines? Now, what we saw in those votes is that the two Democratic senators from Colorado, the two from New Mexico, the one from Pennsylvania, all said, we are not going to vote for that. Our states are energy-producing states, and we're not going to hurt our own states' revenues for it. So even as it stands today, even if they did it along party lines, I think there are still some discussions that would need to take place, some adjustments to the plan before it gets passed. And given the lack of a timeline, given the fact that there's some in the middle that says we want this to be a bipartisan bill, infrastructure is going to take a little longer. When will it come through? I'm not totally sure. My best guess is that we could see a passage this year, but not really see the spending come into effect until 2022. So with that, not as much of an impact from an economic and market perspective. We will certainly see some money flow as people look to areas like some of the technology, which is likely to see some of the investment, like the energy sector, which is likely to see some of the investment. But for right now, there's still a lot of questions that are up in the air.
Yeah, it'll be interesting to see how it all plays out and how it all unravels for us. So I want to shift back over to the markets a little bit and kind of get your opinion once again. And before we do that, just the quick disclosure here for how Radon and I are managing it. We're purely working off of the numbers. We're purely working off of the technicals. And sometimes fundamentals are kind of saying, well, how do we see things playing out from a futuristic perspective? We don't do it that way, but we like to hear and we like to know what the fundamentals are, especially from an economist like you. So how are you seeing things play out for the rest of the year now that we're in second quarter? Had a great first quarter in certain parts of the markets. And so now where do you see things going? Do you see things shifting at all? I know there's been worries, once again, going back to the Fed, whenever they decide to ease their spending and ease their buying into the markets, how does that all play out?
Yeah. So the Fed, from my opinion, I think the Fed is going to stay on hold. One of the things they did, and I think this was kind of smart, that they did when they released the dot plots, that's their projections on where they see GDP growth, where they see employment, where they see inflation, and where they see the rates set by them into this year, next year, and the year beyond. They made significant upward revisions to those forecasts at the beginning of this year. They put economic growth, real economic growth, at 6.5%, which would be the single best year for the U.S. economy that we have seen since the 1980s. And what I think they did is they said, let's make a significant movement here, but at the same time, note that it hasn't changed our outlook on moving rates. So it kind of told the markets, look, things can go better than we were anticipating, and we are still planning on holding pat. And one of the reasons for this is the employment side, because right now we had strong employment numbers in the month of March, and the numbers got revised higher for January, February. But there are still, today, we're still down about 8.5 million jobs from where we were in February of 2020 before COVID hit. That is what they are tasked. That is what they are watching. And they're saying, look, we still have a significant amount of healing to see take place. I think we're going to see some of that healing take place as our downtowns continue to recover. Remember, last year, we moved from the outside inside. We moved from the inside online. we move towards those types of companies that can bring goods and services to us. As we get back out, I would expect the restaurants and bars, the leisure and hospitality, the small and medium-sized businesses that are far more reliant on in-person activity to continue to see some of that tailwind. I think they're going to continue to be leaders as we move into this year. As the inflation pressures build, that's going to put some pressure on interest rates, even without the Fed moving, and that's going to bring some questions. We'll probably see some volatility in areas like technology, where they're more reliant than other industries on investing for the future. They're future cash flow-oriented businesses. They're growth-oriented businesses. So I would expect small and medium. I would expect some of those cyclicals, industrials, materials, financials, to continue to benefit in this environment through this year. Another area I would keep an eye on is as the global recovery takes place. Watch, the U.S. is leading right now. We have about 165 million shots given so far. We're running at just over 3 million a day. We are running faster than virtually anywhere else in the world. And as we get back to normal, the rest of the country, the rest of the world is going to be working to get back to normal. As that takes place, I would expect we're going to see some improved performance from international as well. So not a straight line. It never is a straight line. But it's one of those things, because uncertainty is going to remain with us. Uncertainty is not going to go away. It's not going to go away once COVID is in our rearview mirror. I can't think of a single time, a week that's gone by in the last 1-2 decades where there hasn't been something that brings uncertainty to the markets. But we watch and we see the tailwind factors, and those tailwind factors with that volatility, I think, are going to move things generally higher over the remainder of the year. I think virtually every sector has benefits. I think they're all expected to see rising earnings. Some are just expected to grow a little faster than others.
So we've got like one of those kind of questions we kind of like to close out with. So we're gonna start with the kind of the negative side here. What are you the most nervous about if you had to think about going forward throughout the rest of the year? What bothers you?
Yeah. So the two things that I'm kind of watching, I continue to watch for strains. Right, we've heard about the South Africa strain. We've heard about Brazil. We've heard about the UK strain. And we continue to hear questions about the effectiveness of the vaccine against those. Now, we've known about those since November-ish of last year, and we've been seeing reports of those showing up here in the United States. And so far, we haven't seen a significant outbreak or reacceleration of cases due to one of those variants. But it is a possibility. And if there was one thing I think that could derail activity, is if we were to see a variant take hold, something that the vaccine isn't working as well against or isn't working against at all, and we were to see some return back to shutdowns. I think it's a low probability event, but there's a possibility. The other thing, and this is a little bit longer term, it could be, I'm certainly going to be watching that inflation picture. As inflation picks up, the Fed's going to need to keep an eye on it. I don't think they're going to move this year, but I do think it's entirely possible that they start signaling later this year that, okay, maybe we are going to move in 2023 and that timeline might move a little bit earlier. That's going to roil the markets a little bit when that takes place, as inflation pressures are pushing interest rates up. I don't see it as a significant cause for concern, not something that's going to throw the economy into a recession or that's going to throw the markets into a downturn, but it is going to bring volatility. So those are kind of the two things that I'm keeping an eye on to see how they develop.
Okay, great. So I say we ended on an optimistic note. And Andrew, tell us, what are we most excited about for the rest of this year?
So this is going to be, I think, a phenomenal year for the U.S. economy. It's going to be a great year for economic growth. Our expectation is for the year we're going to bring about 6 million jobs back. That would be the single best year for job gains. I'll say, too, last week I started to get back out. I was traveling. I went to the West Coast, to Portland, and I saw my brother and my sister for the first time that I've seen them in a year and a half. There's bucket list items that are now becoming kind of attainable, things that we've all wanted to do, we're excited to do as restrictions ease, as the environment is safer to get out there and do things. I think there's going to be a lot of joy this year from people getting back outside, back in their communities, back with neighbors, back with friends. So I am very excited for this continued path back towards normal. And I'm really looking forward to, as we get later in the year, celebrating holidays, celebrating events in person with people once again.
Yeah, well, we all are looking forward to being able to be back in person. And by the way, although we're not in person, even right now, we do appreciate you very much coming on and talking to us, talking to our listeners, and really helping us give that big picture view. Sometimes we get stuck in our own little community. So thank you so much, Andrew. We certainly do appreciate your time.
Thanks for having me. Always enjoy it.
We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step by step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, watch this video. Create your retirement income plan. Also, click here to subscribe to our podcast, Secure Your Retirement. If you like this video, hit the like button and be sure to subscribe and share it with your friends.